An idea of how the industry plans to get through these tough times. I spoke to John White. He's a senior research analyst at ROTH Capital Partners. I asked him how difficult it is for companies and workers, for that matter, to weather this storm.
As we move into this year, the employment picture has not seen very many new data points. There have been some reductions in employment at some of the oil service companies, but no large reductions in employment at the exploration and production comments. You're terming this, or the CEO of Conoco terming this a energy renaissance is certainly true. And to give some historical context there, for basically the first 100 years of the oil industry in the United States, the industry drilled vertical wellbores targeting what we call conventional reservoirs. That began to change in the early part of the 2000s when technology increases in horizontal drilling and fracture completion technology made completions in shale formations economic. Shale is not a reservoir rock, so it's termed an unconventional reservoir, and we've just had the efficiency gains have been tremendous, and production has been rising at a relentless pace over the past several years.
And so how has that changed the landscape? Is that part of what we're seeing here?
That's exactly what we're seeing here. Over the last 3 years, first you had people perfecting horizontal drilling and fracture completion in natural gas reservoirs. Then they moved to oil shale formations. And for the last 3 years, over the last 3 years, U.S. onshore oil production is up 3 million barrels a day. That's compared to 6 million barrels 3 years ago. So it's a very meaningful increase of 3 million barrels a day. We're making 9 million barrels a day now. Keep in mind, Saudi Arabia is making between 9.5 and 10 million barrels a day. So quite an impressive figure. As that oil in the United States has moved its way to the U.S. Gulf Coast, it has pushed out imported barrels that were previously being imported to the United States. So over the last several years, there's been 3 million barrels that's had to find a new home, whereas it's not coming to the U.S. anymore.
Your firm, ROTH Capital Partners, of course, makes projections about what it thinks the price of oil and natural gas will be in the future. You actually just revised your prediction down again. The initial estimate for this year was that oil would be around $75 per barrel. Natural gas will be about $3.50. Now ROTH thinks crude will be averaging a little more than $56. Natural gas around $3. Why the change, and why do we continue to see kind of this slippage in the numbers, would you say?
Well, we just felt it was time to admit to the realities of the marketplace. We watched that original forecast came out in early December, and as previously mentioned, oil production from the U.S. onshore has kept rising every week, and so we felt it was time to admit the realities of the marketplace and take our prices down. There were a very large number of oil wells drilled in the fourth quarter of 2014, and those wells will be completed, were completed in January or will be completed in February. So there's still going to be some increased oil production during the first quarter of 2015.